Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look at our UOA today, three iron condor sales from yesterday. I think we had to update them today. What we thought was getting a little too overextended on price and implied volatility got even more overextended, especially on Micron and Qualcomm, and certainly sets up to add maybe a little bit more to the position. We did get into a small position today. We'll maybe look to add tomorrow on the opening if things hold here, but certainly a reason why you want to give yourself plenty of cushion and do it in a defined risk way. So let's jump in and take a look at what happened today, shall we? First of all, here's the scanner from today. You can see Micron number 2 on the list. Yesterday it was in the top 10. Qualcomm in the top 10 again today. So huge repeat, mostly call buying, right? Implied volatility, as we'll see in a second, still at 100%. Massive option buying, right? So what we thought was a little too speculative, guess what? Became even more speculative. So you never want to say, I'm right, the market's wrong, right? But you want to take advantage of what you perceive as edge, do it in a fashion where you have plenty of upside and downside cushion, right? So you can afford, if you will, being too early, right? But many times if you over position size, right, and get too aggressive, being early is the same as being wrong. So taking a look at the IV pop, here you can see on Micron, right, pulled it off today again. You can see Micron just shooting even higher on IV to fresh new highs. You can see from Friday to Monday's close, right? IV jumped even more, right? So things certainly getting even more heated here. Here you can see an over 10-point vol jump on a general basis from Friday's close, which was the highest level we have seen by far in a long time, now getting even higher, right? Plus calls far outpacing puts from an implied volatility perspective. Normally, puts carry a slightly higher IV than calls simply because stocks tend to go down more quickly than they go up. But this is a absolute special kind of case where you're seeing massive call buying, reminiscent a little bit, right, of that, Avis trade that we did a while back, the short squeeze, where the call IV absolutely exceeded the put IV, everyone basically racing for upside. So this is looking short squeeze-ish, if that's a word, right, to say the least, on this aspect as well. But certainly some massive right buying coming in, as evidenced on the option scanner. Over 1 million contracts trading on Micron, well over 300,000 on Qualcomm that we'll take a look at in a second. Here is the skew, right, and you can see out of the money calls trading at a huge premium to out of the money puts. Normally it's flipped, out of the money puts trading at a slight premium to similar out of the money calls. Here's our graph, right? Here was yesterday's close, or in this case Friday, on IV, the highest level, as we said, in the past 5 years by far, certainly spiking. But what happened Monday? We just took it much higher in, again, a parabolic fashion. So things getting even crazier, right? Where it stops, you don't know. But implied volatility, I would think, has a limit. It normally does as far as what will be paid. You can do certainly hedging strategies like simple covered call trades, right? And so forth. So certainly Micron getting overextended. Here you can see the chart, right? Again, getting even more overbought. MACD makes a new fresh high over the past 12 months. Bollinger percent B, even with the spike in IV, which should in some ways bring Bollinger percent B, which has an IV component to it, right down, actually still stayed the same. And I kind of like this price pattern here, this kind of doji, where it traded up to a fresh new high at 818.67, but closed to basically, close higher, but well off the highs. A lot of times this is a sign maybe we're finally getting a little pushback. Obviously, shares trading at a massive premium to the 20-day moving average. We won't even update fundamentals We took a look at those in our last video. Those got even worse here, obviously, today, so no need to mention those, but certainly things getting a little more overextended. But remember, our trade was going out and selling that June iron condor, the 500 490 put, the 1000 1010 call. So even with Micron at just under 800, we're still fine from a price perspective. One more day has passed, right? We only have till June 15th, right? So going out to that June expiration, right, we only have now 38 days to go, right? And we have still over 200 points of upside cushion on the trade. So even though the fact Micron went higher again today, it certainly isn't a worrisome price level yet, right? Implied volatility, like I said, we may look to add to the trade simply because things are getting even more juicy, right? And do it in a low risk way, right? We only did 2 contracts of each, right, to start with. We might add 2 today. Taking a look at Qualcomm from that implied volatility perspective again from Friday to today, you can see just ripping to fresh new highs, right? You can see from Friday's close till Monday's close, moving on that kind of area we're at, right? From well under 75 to approaching almost 80, so a big pop in implied volatility. Here you can see it right now for the first time generalized well over 80, a 7-point almost pop on IV, right? You can see on Micron we had that kind of huge pop on IV from a price perspective of over 10 points, so massive pops on implied volatility. And implied volatility from basically a month ago has pretty much doubled. It was trading right around 40, now trading right around 80. So things certainly getting very extremer, I guess is the word. Here you can see that same skew graph, out of the money call trading a massive premium to out of the money puts. Normally that's flipped a little, and here you can see the big volume in June up 9 vol points. And again, here's that 5-year chart. Here's where it was on Friday's close. I just shot well past it. Intel, and let's take a look at the Qualcomm chart as well. You can see maybe showing a little sign of fatigue, right? Had that, move towards that 248 almost level, reversing close 10 points lower. So maybe a sign of exhaustion. Again, 9-day RSI by far the highest level over the past year. MACD absolutely at an extreme. Bollinger percent B still well over 100, right? And shares trading at a huge premium to the 20-day moving average. So again, maybe this is a sign that things are getting a little overextended. We keep getting these pushbacks. One day it will work here, but again, with Qualcomm, our trade, right, was simply going out selling the 270 or 280, 290 call spread, right? 170, 170, 160 put spread. So basically don't get in trouble until 280 on Qualcomm, right? And as you can see today, we're closed well below that. We still have 45 points of upside another day pass. So that's the beautiful thing about using implied volatility, having that huge cushion. Days like today, right? You don't worry too much about the IV mark, right? That will eventually, hopefully, go away, right? And we know expiration, it will be at parity, but we still have plenty of upside cushion on the trade here on Qualcomm, to say the least. And then finally, Intel from an IV, the one that kind of didn't do much of anything, maybe a signal these other two are ready to calm down. Here you can see Intel just kind of flatline, right? The very short-term options actually dropped, longer term moved up a little, right? But you can see here the kind of, this is a, shorter term kind of IV, pretty much flat, right? Dropping a little bit actually on IV as we see on the chart here, right? So maybe getting a little semblance of sanity. Here's that skew chart. And looking a little more normal, right? Well out of the money calls, right? Still trading at a premium to the well out of the money puts, but certainly not the level that Micron and Qualcomm did. And here you can see the June options certainly flat on an implied volatility. Here's that 5-year chart. Again, IV pretty much flat. So Intel finally maybe showing some weakness. Certainly, IV can pull back under 80 in this area here towards this old high, if you will, and still be very rich, but that would help our trade out immensely. And then a pullback in the stock a little bit, but on Intel again, our trade, we have plenty of cushion on that. We're all the way to 165 and then 90 on that stock, right? And we can take a look at that Intel chart. We can see Intel, the same thing here, that kind of doji, right, where it made that new high, really didn't rip higher, and we still have plenty of upside cushion on Intel. As we said, we don't get into trouble on the trade till 165. The stock's at 130, just under it, right? And we are running out of time a little bit here out to June, so we have plenty of still upside cushion. So using IV to structure the trade makes a lot of sense. And we did get into the trades, as I said, right on the opening today. So Qualcomm got in at 225 for two contracts, selling the 292.80, 170, 160. Intel, the one we talked about, two times at $1.34, and Micron two times at 230. We'll keep you updated on that. Got about an 82 IV on Qualcomm, 100 IV on Intel, 98 on Micron. And here's the actual time and sales, right, from the prints, both in the account, right, and from the Thinkorswim website. So I think it's fascinating, this trade, and I think it's a great time to take advantage of this just extreme move higher in IV, right? Anytime you get this kind of move in IV, right, it rarely lasts that long, right? And now we're getting to levels we really have never seen by any stretch of the imagination before. So any kind of reversion should certainly help out the positions, no question about it at all. So it's another reason why using implied volatility along with technical and fundamental analysis, that fusion approach we do here at Big Time Options, provides you with that kind of comfort to have the trade move against you a little, at least short term, and we have defined risk up front. So position size accordingly, define your risk, and take advantage of the edges when they appear. Put on the trade, find the edge, then put on the hedge. So we'll keep you posted on this. I think this is one of the most interesting trade possibilities we've seen in this space, basically maybe forever, but certainly in a very long time. So we'll keep you updated, and until next time, as always, here's a good trade.